In this video, we will explore about the Settlement Guarantee Fund and the Investor Protection Fund. We will take a comprehensive look at the safety mechanisms that keep our financial markets secure. Along with these core safety nets, we are also going to discuss some of the most recent regulatory measures introduced by SEBI to further strengthen the market and protect investors like you. Let us start by understanding the Core Settlement Guarantee Fund, which is managed by the Clearing Corporation. Think of this as a dedicated emergency reserve. The Clearing Corporation maintains separate funds for different market segments, like the cash market or the futures and options segment. The primary objective here is simple. If a clearing member suddenly fails to honor their financial commitments and cannot pay up, this fund steps in. It covers the missing money so that the final settlement of all trades is completed smoothly without causing any panic or disruption to the normal market process. Now, what happens to the individual investors if a broker defaults and does not have enough assets to pay back what they owe? This is where the Investor Protection Fund comes to the rescue. The stock exchanges have set up this specific fund to financially compensate regular investors in such bad situations. It acts as a direct financial safety net for you. This fund is strictly administered by a specially created registered trust to ensure fairness. Besides paying out claims, this money is also actively used to promote investor education, spread financial awareness, and conduct market research. Recently, SEBI has adopted several new rules to make the equity index derivatives framework much stronger. The main goals behind all these changes are to ensure robust investor protection and maintain overall market stability. There are 6 major measures we are going to look at. These include changes to option premiums, the removal of certain spread benefits, stricter intraday monitoring, revised contract sizes, limits on weekly derivatives, and extra coverage for extreme market risks. So, let us walk through each of these important changes one by one. The first major change involves the upfront collection of option premiums. Starting from February 1st, 2025, there is a strict new requirement for brokers. Trading members must now collect the entire premium amount upfront from anyone buying options. The main objective behind this move is to limit undue leverage. By forcing buyers to have the full cash amount ready before they trade, the regulator aims to significantly reduce the risk of people taking on larger positions than they can actually afford. Moving to the next rule, which also takes effect on February 1st, 2025, we look at the removal of calendar spread benefits on expiry days. In the past, traders could get a discount on their required margins if they held offsetting positions, which are known as spread benefits. Under the new rule, if your contracts are expiring on the exact same day, you will no longer receive these margin offsets. The reasoning for this change is to carefully address basis risks and curb the wild speculative volatility that often happens right on the day contracts expire. Another big step for market safety is the new mandate for the intraday monitoring of position limits. Starting from April 1st, 2025, stock exchanges are required to keep a much closer eye on the maximum trading limits allowed for participants during the actual trading day. Instead of just checking at the end of the day, the exchanges will now take at least 4 random snapshots of the market positions every single day. This constant checking ensures that no one is quietly taking on massive, dangerous risks while the market is still actively open. Let's look at a change that directly affects the size of your trades. Effective from November 20th, 2024, there is a revision to the minimum contract sizes for index derivatives. The new requirement states that the minimum lot size for any new index derivative contract will be noticeably increased. The target value for a single contract is now set to reflect a total market value of rupees 15 lakhs to rupees 20 lakhs. This higher entry barrier is designed to make sure only serious participants with adequate capital are trading these highly complex instruments Continuing with the changes implemented from November 20th, 2024, SEBI has also rationalized weekly index derivatives. Previously, there were many weekly options expiring on various different indices, which led to a lot of speculative gambling. Now, there is a strict restriction in place. Each stock exchange is only allowed to offer weekly expiring derivative contracts on just one single benchmark index. This focuses the trading activity and drastically cuts down the daily frenzy associated with multiple weekly expiries. Also, starting from November 20th, 2024, there is a new rule for additional tail risk coverage on the specific day a contract expires. This targets traders who sell options, known as short options. The new measure applies an additional extreme loss margin of 2% to these short positions on expiry days. The clear purpose of collecting this extra 2% is to perfectly account for the heightened speculative activity and sudden price swings that almost always occur during the final hours of an expiry day. To summarize everything we have discussed, these recent SEBI measures are built like strong pillars to uphold total market integrity. By bringing in all these changes, the regulator aims to reduce excessive and dangerous speculation by traders. They heavily improve the overall risk management practices across the entire financial system. And finally, these updates ensure that our regulatory framework is perfectly aligned with the fast evolving dynamics of the modern stock market, ultimately keeping your investments and the broader economy safe.